All right. Today is Sunday, September 10. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. But let's begin with this. You know I'm a human being and sometimes I go through rough patches in life. But having you guys around, reading your comments, seeing that my work at least has some benefit makes me really happy. So all I got to say is I appreciate you, I love you, and I'm lucky to have you here. And now with the ass-kissing session out of the way, we go back to the discussion from last week. The chart of the SPX, the cash index for the S&P 500. We talked about how when you have a bearish engulfing candle and you have a closing above, you have a bullish reversal. You're supposed to be buying the stock market. This is what the technicals say. But there was a lot of skepticism about this rebound, even among the most bullish members of our community. They were not really buying it. And now, fast forward, we can see that the doubters actually had some ground here, that maybe shouldn't fall in any of these rebounds yet. And despite the fact that the market took a shit this week, a lot of folks are still defending this rebound. Just like the folks who defended the Delta Airlines passenger who took an explosive diarrhea across the plane. Would you like to switch places with me? Because I'll be happy to do so. You can sit with shit, I'll take the snakes on the plane. But we also have folks who believe that the rebound is dead now, it's over, it's gone. But don't assume that the market is dead yet because you could be mistaken, just like the guy who called 911 reporting yoga students as mass killing. To understand the market's fate, we have to understand the economy's fate. And for that, we have to go back to the wall of worry. And the reason is an important item flared up this week, which is China. You see, this week we got the news that the Chinese government may be limiting some access to iPhones by government workers, and some are describing this as a ban. And of course, we know that maybe the Chinese government is looking for broadening this ban to state firms, investment firms, government agencies. And the question now becomes, what's next? Will China ban Apple altogether? Of course, you'll hear different accounts. For example, the pumpers would say, oh, the Apple sell-off this week was overblown. The concerns are overblown. China will never really ban Apple. They employ a lot of people in China. And Xi Jinping is not really that stupid. So please stop selling and buy Apple. Otherwise, if Apple goes down, the entirety of the stock market goes down with it. And did we say that we're waiting for the annual bonuses? Yeah, we got to pump the market a little higher all the way till the end of the year. And all I got to say is good luck. And the reason is whether China bans Apple or iPhones altogether or not, the damage is already done. When you have state agencies banning iPhones, when you have the government warning about, oh, maybe iPhones are compromised, the damage is done. If you happen to be in the Chinese population, now you get a question if you're buying an Apple, are you being spied on by a foreign country? Is Apple sharing your information and your personal data with a foreign country that happens to be also an adversary? Furthermore, we talked about that this is sooner than later, let's stop beating around the bushes here and get to the point. We are now in a process of economic decoupling with China. Whether we like it or not, it's gonna happen. It is inevitable. The honeymoon is over now. We have enjoyed years of higher corporate profits because we got cheap labor in China. And when the economy started to prosper in China, corporate America also benefited by increased revenue. They sell more because they have increased purchasing power in the Chinese economy. But now the honeymoon is over. Whether we're talking about, the slowdown in the Chinese economy, and corporate America was used for years and years and years on positive, not just positive, but explosively positive economic growth in China, which accelerated revenues for U.S. firms. But now with China getting weaker economically, that tailwind now becomes a headwind. Furthermore, when we talk about cheap Chinese labor, well, that's not the case anymore. Wages are rising in China. But most importantly, because of national security issues, China is now not just a competitor, but it's a foe, and they're advancing militarily, economically. At some point, the United States doesn't want to share the world with China, which means that it is the time for the two countries to decouple economically and use national security as a cover. All of a sudden, the tailwinds, number one, the explosive, forget about the explosive, I'm now thinking about the diarrhea story from Delta, but let's say the impressive growth in the Chinese economy in the last few years, that's no longer now. Used to be a tailwind, now the slowdown in the Chinese economy is a headwind. And then you got tailwind number two, which used to be cheap labor from China, which improved corporate profits here in U.S. companies. Well, that's not going to happen anymore as we have national security decoupling with China. And now manufacturing has to move back home, or perhaps to other countries with higher labor and wage standards. Now, what does that mean? A source of growth for U.S. companies is now no longer, and a source of growth in corporate profits is now no longer, as they have to pay more to manufacture stuff here. Now, with understanding this dynamic, does it really make sense to expand the valuations in the stock market, as we see perhaps one of the most important tailwind for U.S. companies in the last few years, China, now becoming a headwind? I think it doesn't make sense at all. What makes sense is contracting the valuations in the stock market. And this is the problem that we have, folks. The market is not attached with reality. And we can play the game of, oh, the market can stay irrational longer than you can, whatever the f***. But at the end of the day, the market will snap back to reality. It always happened this way. So now when we talk about the wall of hope, we know that China is no longer. China's now in the wall of worry. We used to hope that, oh, China reopening will counter the slowdown from Fed rate hikes, and we see the economy moving into a soft landing. Maybe we can see contraction domestically because of the Fed interest rate hikes, but China is going to be a source of growth. Well, we know that's not going to happen anymore. So the wall of hope lost an important pillar. And I believe that we're about to lose another important pillar, which is the hope that the Fed and central banks are done with quantitative tightening. Not only that, because the market doesn't look at, oh, the end of quantitative tightening or pausing. The market takes that as a certainty. The market wants interest rate cuts, and the market is rallying, believing that the Fed will cut rates really soon. And don't forget about interest rate hikes. That's not going to happen anymore. Well, the question becomes, what if this assumption collapses? Look at this headline, for example. It says the Fed's own economists now expect a Goldilocks scenario. They keep talking about this Goldilocks scenario, the golden path, as this moron Goolsby says. Soft landing, some say. No recession, low inflation, and positive growth. Well, the problem with the recession is when it happens, it just happens and it hits you really hard. And it's too late for you to realize that we are in a recession because you already got hit. They don't send invitation cards, hey, by date so-and-so, the economy is going to go into a recession. Prepare yourself. It doesn't happen that way. So we have to look at low inflation and positive growth. Now, I don't know what the folks at Business Insider has been smoking, but the assumption of low inflation, well, let's talk about that in a minute, but let's begin with positive growth. Recently, we've been getting data suggesting that perhaps this positive growth story is coming to an end. For example, you look at the revisions in the payrolls from the Bureau of Labor Kitchen Statistics. When you start to see revisions going down, all of a sudden, whoa, did we say that the economy created 150,000 jobs in the month of June? Oh, make that 50. We just made up 100,000 jobs. A little too much salt here. Well, when they start to revise them that big, consistently, usually it is a sign that the economy is heading or already in a recession. So now we're getting data suggesting that the economy is actually slowing down, and perhaps the growth is slowing down rapidly. Here's another piece of data that we got this week. It reads U.S. factory orders plunge in July after 4 straight gains. So somebody please send an update to Business Insider that this is what's actually happening to the economy. But to me, the winner headline for this week is this one. It reads, Southwest Airlines stock drops as August leisure bookings were on the low end of expectations. Uh-oh. I thought the economy is booming and everybody's traveling. Revenge travel. I guess Taylor Swift and Beyonce sucked all of that budget out. In any case, notice that lately, the majority of job creation, according to the Kitchen, took place in the hospitality and leisure sector of the economy. Well, isn't this a sign, a leading sign, that this sector is slowing down? Number one. Number two, if this sector is slowing down and we start to see revenues and profits going down, wouldn't the response be to get rid of employees? And we start to see the unemployment rate moving higher. A lot of the jobs that we created recently, they go kaput, and the economy starts to break down rapidly. And again, there is no invitation cards. It happens so fast. Either you're going to spot the leading indicators ahead of time, or you will be caught with your pants down. What's really important is this headline right here. So Southwest said that bookings for leisure are actually down. Now you combine this with the fact that they're sounding the alarm along with United Airlines and many more about rising jet fuel costs. Now if you watched my video back when I did the Delta Airlines earnings, I warned about this, folks. I said airlines and transportation are short, stone cold short. Cruises, airlines, and the reason is, last year the problem was the increased cost of jet fuel. Okay, that went down, but it was made up for and then some by the increase in wages. Now we see jet fuel moving higher again. So it's a double whammy on airline companies. What do you think the response will be? Well, so long as they can pass the extra cost to the consumer, to us, so far so good. But if they say that leisure bookings are down, then they can't really pass the extra cost to us, which means that their profits will collapse. They're going to start to lose a lot of money here. And the remedy will be cutting wages or getting rid of thousands of employees. So this tsunami of layoffs is coming, folks. And this is the leading indicator. The most important question now becomes, are you listening or are you jerking off right now? Don't come to me later on and say, oh my God, Maverick, what happened? All of a sudden the economy is losing jobs. All of these leisure and hospitality jobs are going down the meat grinder. And when we talk about jet fuel and we go back to the headline from Business Insider, so now we have signs that growth is actually slowing down dramatically. But in the headline, they say, hey, the Goldilocks scenario, no recession, low inflation, and positive growth. Well, we know that recession happens. Positive growth is slowing down a lot and really rapidly. What about the low inflation part? Well, we know that inflation is not really low. The pace in acceleration of prices is slowing down. But maybe it bottomed already. Yet prices are not really low. Inflation is not really low. We all know what we're paying in rents. We all know what we're paying at the grocery store. Utility bills, through the roof. Insurance cost, unbelievable. And now you're paying your credit card debt with higher rates and you're about to pay your student loans. We know that inflation is not really cooling off. The question becomes, is it accelerating? And the answer is absolutely yes. And if growth is going down and inflation is accelerating, then are we really in Goldilocks scenario or are we in stagflation, baby? I think the answer is clear. And now you know what's going on. Saudi Arabia cut the supply of oil, and we see that oil prices are moving higher. Now they say, oh, this is all because of Saudi. I would say the Fed has a role in this. The prices of crude also bottomed right around the Fed pause in June, which I believe was a colossal mistake. And they're about to repeat it again in the month of September. Oh, we're going to skip, we're just going to pass. Well, you watch, oil prices will go back to 100. And I'm not the only one warning about that. Goldman Sachs is now warning that Russia and Saudi cuts could send oil prices above $100 a barrel by the end of 24, just in time for election day. Now, I would say make this by the end of 23, before elections even begin. And unlike last year, the problem this time around is the Joe B administration has no ammunition left to fight the supply cuts by Saudi, to drop prices, aka to manipulate prices down. And the reason is they have depleted the SPR. So what happens now? The Joe B administration is and of course, thank you to the imbecile energy secretary, which she shouldn't even be anywhere near that position. She's not even qualified to be a dog catcher, let alone energy secretary.
What is the Grantham plan to increase oil production in America?
Oh my God, that is hilarious.
And folks, when we talk about decoupling in the new world order, see, the world is changing right now. You don't realize it, but we're living in historic times. You see, in the last century after the war, 1950s, all the way to, let's say, our point right here, it was good times for the most part. A period of economic boom, a period where the United States is the dominant player. Sure, the USSR was a competitor, but the US dominated, most importantly in countries with resources. Now things are changing again. We have wars all of a sudden. We have hostility between nations, bigger nations. We have rising nations such as China, India, and they're all interested in doing what's best for their nations. You have rich countries now rebelling against the old regime that is dominated by the US and the dollar. And among these countries is Saudi Arabia. The US is not really an important trading partner with Saudi anymore. China is. And now as China becomes more powerful from a military standpoint, you see the Saudis moving closer to the Chinese side, and they don't mind anymore to let the United States know that, hey, we're going to do what's best for Saudi, which is higher oil prices for longer. It is a sign of a new world order that is forming right now. It is a sign of economic decoupling in the old world order. And it's not just Saudi defying the US by cutting supplies and increasing prices of oil. They're also dumping billions of dollars of their holdings in US treasuries. And this will push interest rates in the US higher and higher and higher, because Saudi is dumping, China is dumping, the Bank of Japan is about to dump, maybe dumping already. The Treasury Department is dumping. The Fed is dumping. And we see rates moving higher. But the fact that the Saudis are not buying U.S. Treasuries and rather selling them tells you a lot about what you need to know about this new era of economic decoupling. We're living in historic times. We're going to see a lot of disturbances and a lot of conflicts as the new world order forms out of the old world order. And of course, last year when oil prices went higher, the Joe Biden administration decided to be softer in Saudi in hopes that oil prices will go down, in hopes that Saudi will do something here. And of course, the geniuses at the Biden administration decided that a fist bump is the way to go, which the Saudis took as an insult. And fast forward to the G20, which happened just over the weekend. Here we got the Indian Prime Minister Modi looking at Biden saying, hey, look, I shake his hand. I'm not dying here. Maybe you should try it, Joey B. And Joey B stands up and, I gotta shake his hand, Jack. They told me to fist bump this guy. Think about what you think about. And then, of course, Joey B says, okay, I'll shake his hands. Here you go. 10% for the big guy, okay? You can keep these oil prices higher, Jack, so long as you kick 10% to the big guy. And the problem with the recent extensions of supply cuts by Saudi is we thought in Q4 we're going to see supplies coming back into the market. But with the extensions, there is a reckoning. We have to recalculate all of that. And you see oil prices right now surging higher. And I don't think that we're finished yet. So again, when we go back to the Goldilocks bullshit, when they talk about low inflation, what are you talking about here, Jack? Inflation is actually recovering and moving higher. Did you look at the chart of heating oil, aka diesel? Did you look at the chart of the WTI or Brent? All of that is going to start to be contagious across the economy. The cost of transportation will go higher, the cost of shipping, and that's going to just bleed around the economy. We're going to see inflation moving higher again. It's already happening. We got leading indicators this week. For example, the Philippines, massive beat in inflation. The highest forecast was a 0.5% increase. The actual reading was 1.1%. We saw the same thing in Korea, in Thailand, in Taiwan. All of these inflation readings this week came higher, beating expectations. And we also have the wage issue. We know what's going on with the UAW, and we have a strike coming. The strike now is in the bag. It's going to happen this week, which means that General Motors, GM, will be paralyzed, along with Ford, maybe not so Stellantis, but the damage is done. They're going to secure higher wages, and that's inflationary, and that's contagious to the economy. You see, this week we got a confirmation of all of that. The headline reads, U.S. unit labor cost higher in the second quarter than initially thought. Oh, you're saying that inflation is actually moving higher. Now look at the sub-headline. Q2 productivity growth trimmed. That means cut to 3.5%. So you have growth slowing down, revised down. You got inflation revised higher. What are you talking about when you say Goldilocks, you morons? And keep in mind that Taylor Swift is still touring around along with Beyonce, and that's more and more and more inflation. You gotta book the hotels, you gotta buy the dresses, the bracelets, the airline tickets, dining, booze. All of that is inflationary. So now we know that we have a dynamic of higher inflation but weaker growth. And perhaps this week, the services PMI confirmed all of that. You see, the headline reading was down. So business activities are actually trending down, but prices are moving higher. They're bottoming and moving higher. Even Chris Williamson from the S&P suggested that this could be a hint of rising stagflation. I told you folks, you gotta prepare your ears to start hearing stagflation a lot. Think about the dynamic of, for example, smartphone shipments going down. So we know that the smartphone market is now oversaturated, and Apple reached the maximum market share, so did Samsung. And from here on, they're gonna start to lose market share. Well, how do you compensate for that? The answer is you raise prices higher. We see the average price of a smartphone moving higher. That's inflationary. And it's a dynamic that's not going to change anytime soon. You look at Netflix, for example. What if they got everybody they need to get and there is no growth anymore? Everybody who wants to be a Netflix subscriber is already in. Then what is the avenue for growth here? The answer is raising prices on existing consumers because you've already tapped out. You can't get any more. Out of whatever billion human beings in the planet, you've already maxed out. Now you have to increase prices higher. Otherwise, you have no growth left. And that is an inflationary dynamic that will not change anytime soon. So we go back to the wall of hope. The Goldilocks / soft landing / bullshit scenario. It all depends on growth going higher, inflation going down. What we see is the opposite. Growth going down, inflation moving higher again. We have a CPI report coming out this week. Could we see, finally, one of the most important pillars in the wall of hope getting demolished? That is a possibility. And if that is the case, the market's reaction will be absolutely horrific. Now, what about the third pillar in the wall of hope, which is perhaps the most important one right now? AI, which is, by the way, just NVIDIA now. Every other AI name reported and there was nothing to see. No revenue increases, nothing. So it's all about NVIDIA now. And of course, you might have heard recently that we have a lot of questions about NVIDIA's recent revenue and guidance. You see revenue moving higher, but somehow costs not moving higher. And the rate of growth suggested by NVIDIA is nothing we have seen before, even in times of war and pandemics. So the question now becomes, if there is this massive increase of revenues for NVIDIA, who's buying them here? If China's not supposed to buy them, if Saudi's not supposed to buy them, then who's buying? Well, NVIDIA says companies like Microsoft and Amazon. Well, if that is the case, then how come we haven't seen massive increases in spending by these companies? We haven't seen massive increase in accounts payable or R&D cost or cost of goods sold. We haven't seen any of that yet. When you look at the guidance by these companies, there's no reflection at all to match this massive increase in revenues by NVIDIA. We don't see that matched by a massive increase in spending by these companies, be it Microsoft, be it Amazon, be it whoever. Of course, we have Oracle's earnings coming out this week, and this is supposed to be a major buyer of NVIDIA's chips, so we'll see. If Oracle is spending more, maybe Oracle is spending all of these billions of dollars. We'll see. And of course, a lot of folks raised alarms that this CoreWeave company supposedly securing $2.3 billion in debt using NVIDIA chips, a company nobody really heard of before. And now we have more questions than answers. What's going on here? Who's buying all of these chips? What's going on with CoreWeave? Is it a front for the Defense Department, the CIA? Maybe that is the case. Maybe the buyer of all of these chips is the Pentagon for national security reasons or whatever. If that is the case, so be it, but don't insult our intelligence here by suggesting that these numbers are real. They're not. Something doesn't add up here. If there is a massive spending spree by companies, how come we haven't seen that reflected in these companies' earnings? And if we have these massive orders for NVIDIA's chips, then somebody has to manufacture them. Well, how come we haven't seen any of the manufacturers, be it Taiwan Semi or Samsung, increasing their guidance all of a sudden? Oh my God, we just got this massive order from NVIDIA. They were actually revising down. The growth is not really that impressive at all in these companies. So there is no reflection of NVIDIA's revenue, either in corporate spending or in the manufacturer side, on the demand side, on the supply side. No reflection at all. So all what we're doing right now is asking questions, which we are entitled to and what we're supposed to do. But of course, the media and Wall Street are now attacking all of us by calling us conspiracy theorists, calling us Twitter randos. Well, if you've been keeping score, the so-called conspiracy theories are now what? Up 10-0? And folks, if it turns out that perhaps maybe we're seeing NVIDIA accounting revenue before that revenue is realized, before these orders are manufactured and delivered, then this is a violation of accounting. And folks, they got in trouble before with the SEC, with investors before, because NVIDIA has this funny accounting. And if they're accounting for hypothetical orders, somebody says, hey, I'm going to place an order for 4,000 NVIDIA chips, and they count that as revenue before the items are manufactured and delivered, they're going to be in a world of trouble here. But perhaps most important than CoreWeave and all of these theories is, what if what we're seeing right now is real, but it's just transitory demand? It's happening because we have an AI mania. It's going to come and go. Then look no further than Pfizer's revenue, which exploded higher during the pandemic and the vaccine mania. We saw the quarterly growth year on year exploding higher above 100% during the pandemic for Pfizer, and the stock shot up higher by about 90%. And then what happened? The pandemic mania came down crashing, and with it, Pfizer stock. The question now becomes, did we just expand the multiples of NVIDIA and the stock market based on a transitory period of increased demand? And if the answer is yes, then we have a major reckoning coming. I don't think the stock market will be able to handle all of that. If we have news that, oh, the CPI is actually moving higher, and oh, by the way, NVIDIA's revenue is based on orders, or maybe transitory increase in demand, then you see all of the pillars in the wall of hope collapsing together. And could it be the September/October event? Could that be the black swan? You see, when we look at the seasonality of the stock market, in this case we're using the NASDAQ, because that's what's really important right now, that's where the majority of the rally comes from. I believe that seasonality is voodoo science, but this year it has been pretty much spot on. So if we consider the seasonality for September, what do we see here? In the beginning of September, the first week, we get a perhaps pullback in the stock market. We got the pullback. Then there is a big rally. And the question now becomes, and I warned my members that be careful here. If you made money on this 180 from the rebound, you might want to consider booking some profits here just in consideration of the seasonality. And the reason is, if you look at the dollars chart, for example, a daily chart, it is way overbought. It's due for a pullback. If you look at bond yields, they're also maybe due for a pullback. You look at oil prices, the charts are overextended now, maybe due for a pullback. What if we get the pullbacks this week and the market rallies and we see the September seasonality playing out? And then in the second half of September, to be precise, around the 13th or the 14th of September, we see the market going down sharply. Gee, what do we have on September 13th? The answer is the CPI. What if the CPI comes out showing a receleration in inflation and perhaps higher than expectations? What if the CPI is 3.8, 3.9, maybe 4? That would be shocking to the stock market. We would see a major pillar in the Goldilocks bullshit collapsing, and with it the stock market. Something you got to consider here as we head into a new week. Anyhow, folks, let's talk about the stock market information for you. We begin with the closing of the indices on Friday, and here we go. The Dow Industrial Average closing positive by 75.86 points, or a gain of 0.22%. The Nasdaq also positive on Friday by 12.69 points, or a gain of 0.09%. The S&P positive by 6.35 points, or a gain of 0.14%. The sectors on Friday led by energy. Well, that's inflationary, that's not good. Then utilities, that's defensive, that's not good. Then you have communication services, maybe due to Meta. We'll see in the heat map, but the laggards, industrials, and expansionary sector, and the real estate, which is sensitive to what? Bond yields. If bond yields go higher, real estate goes down. So the setup doesn't look good here. Real estate says that yields are going higher. Energy says that inflation is going higher. Utilities say that watch out, we might switch to defensive posture here from offensive. We might see value catching a bid versus growth. When we contrast this with the weekly performances for the sectors, what do we see here? Coming up at number 1, capturing the gold, the silver, and the bronze. Energy, the only positive sector for the week. You see, a lot of you in response to last week's video said, hey Maverick, under stagflation, what do I buy here? And I said right now it's only energy, because unless the dollar starts to stop and trend down, we're only going to see energy holding. The rest are not going to hold. Now, if the dollar goes down and starts to trend down, we might see defensives moving higher, we might see healthcare appreciating, but that's only going to happen if the Fed backs off. Well, why would the Fed back off at this point when we have inflation moving higher again? Well, it's only going to back off if we have a disaster in the labor market. If that happens, wouldn't we have the combination of a weaker labor market and higher inflation, which is indeed stagflation? So for now, in the beginning stage of stagflation, at least the official one, I believe that we've been in stagflation for a long time. But officially, right now, in the beginning stages, energy shines. And then later on, as the economy starts to weaken dramatically, we see the dollar cooling off, and then we see gold, silver, defensives, staples, healthcare companies, metals starting to shine. But for now, it's energy. And that's it. And you see it right here, right in front of you. We look at the breadth on Friday. What do we see here? NYSE 49% advancing versus 49% declining. The NASDAQ 42% advancing versus 54% declining. So we're almost at the neutral line here on Friday. A lot of it has to do with options expiration in the market maker. They make one move in the morning and then they do the opposite midday and they close the market pretty much flattish. And I talked about that in my Discord in the morning brief. We will see one move, then the opposite move. And if that happens, the market maker wants to flush the majority of call and put options holders. But now what? What do we do from here? Because the breadth is neutral and it allows for the market to go higher or down. If you're bullish, you'd look at the seasonality and say at least we have a big rebound coming. If you happen to be bearish, you'd say no, Friday was the anomaly because of options expiration. And now we're going to resume what we began. More downside to come. And the bears are supported now by the technicals. The mechanics supports the bulls at least for now. We look at commodities. What do we see here? The dollar was up a little bit on Friday, but all in all, flattish. But so long as the dollar holds, it's not going to be good for metals, so we see gold, silver, kind of flattish, be it to the downside, platinum, copper, palladium, all down. But you look at the action by gold and silver, they're not down by a lot. Maybe they're bottoming here, maybe they're saying watch out, the dollar is due for a pullback, and it is due for a pullback. The question now becomes, is it going to happen right away? And we see a rebound in the stock market hitting into the CPI, or do we see one major pop in the dollar and the market flushes down yet again, and then we see the dollar moving down and equities rebounding? The dollar is really important to watch this week. But we know that the dollar is not really becoming a headwind anymore for energy. We see that crude oil, WTI, and Brent all up by about 0.5 percentage point on Friday. The RBOB futures up about 1% on Friday, heating oil up about 2.25%, and then natural gas was up about 1.5%. So we see energy higher and higher and higher. What also keeps going higher is OJ, orange juice futures exploding higher with no stop inside here. The supply is absolutely awful, be it in Brazil or Florida. So expectations for higher and higher orange juice prices. It's a luxury now. If you want to get laid, just have a bottle of orange juice and walk in a bar. They're all going to think you're rich. Anyhow, moving on to the big casino, the options market, what do we see here on Friday? We see that the volume moved a little higher. Again, in the most popular names, Tesla, Apple, Nvidia, Amazon. AMC, though, the volume went down big. And with it, AMC, it's collapsing right now. We see that they're still buying calls versus puts, although puts are making a comeback here. And most importantly, if you watched my video before the rebound in the stock market, what did I say? I said, look, now that the put to calls ratio is back to 1-to-1, we're going to see call options buyers coming back and calls are going to overwhelm puts once again. And we see this ratio dipping back. Then we're going to see them buying puts again until the ratio becomes really, really excessive. And then we see a legitimate tradable bottom. And for now, it appears it's heading this way. The chart dipped down in favor of call options as we headed back to neutral. Now, I believe that the dip is done, and we're going to see more buying of puts all the way until it becomes really excessive. Moving on to the unusual activities that took place in the options market on Friday, and I'm highlighting the trade for the Qs because they've been betting this way. On a big move coming, big downside move for the most part, but they're also betting on a big move to the upside coming. Maybe it's the September seasonality, who knows? But they keep buying these options with massive implied moves. A cent here, 2 cents there, 5 cents maybe. They're lotto tickets really, but they're betting that it's going to happen. When I see that kind of behavior, I think they're right. I think the big move is coming. The question becomes the timing. If you can time it right, you can hit and nail one of these trades and become really, really rich. But anyhow, what about PEP, PepsiCo? Now, consumer staples, any dividend-paying stocks really suffered this year, especially recently, as we saw bond yields moving higher. And the argument becomes, yeah, they're good companies. PepsiCo, all of these consumer staple companies, they're really good companies. But there is also a risk as the consumer gets weaker. And we're holding all of these stocks in our portfolios because of the generous dividend. Well, if I can get 5.5% from a CD or a money market fund or bond T-bill, why would I even bother with consumer staples? But the sell-off became really, really excessive to the point where it becomes a real good opportunity to at least trade some of these dips in consumer staples that are really, really oversold. They're going to rebound big. Whether they recover or not, that's a different story, but the rebound could be a juicy play for a trade. And here we have somebody who bought the 190 calls for the expiration date, November 17th, with expectations that PepsiCo will move higher and gain more than 8% by the expiration date. Paid about 85 cents a piece to enter this trade, all in all spending about $850,000. And then we have ORCL for Oracle, which I believe will be an important event this week because we have earnings coming out. It's going to be either a validation of Nvidia's revenue, or it could show one or two things. Number one, maybe that the spending is happening, but it is excessive and it's damaging the margins of Oracle. And in this case, the stock goes down big. Or maybe we're not seeing a lot of spending by Oracle in buying Nvidia chips. And now the question remains, who's buying the chips by Nvidia? Anyhow, somebody bought the 119 puts for the expiration date, September 15th, with expectations that Oracle will go down and lose more than 6% of its value by then. Paid about 85 cents a piece to enter this trade, all in all spending about $800,000. And lastly, what about the ticker VZ for Verizon? Now, we just talked about how dividend-paying names are out of favor so long as bond yields continue to go higher. And Verizon pays a generous dividend, over 7%, and they increased it even more recently. But the stock is still not attractive. If CDs are paying 6.5%, then Sure, it can pay 7.5, but what about the risk here? So we see these stocks suffering, even though the fundamentals are really good. Not necessarily in Verizon, but in a lot of dividend-paying names. So here we have somebody betting that perhaps bond yields will go higher this week, heading into October, and this means that a lot of dividend-paying names will actually go down, including Verizon. So they bought the 31 puts for the expiration date, October 27, with expectations that the name will go down and lose more than 7% of its value by then. They paid about 45 cents a piece to enter this trade, all in all, spending about $250,000. On to the heat map for Friday. What do we see here? Mixed picture across the board, but mostly positive. There wasn't any theme either, because if you said, oh, the dollar went up or down, then you see dollar-sensitive sectors such as industrials was down for the most part, but we saw some metals do okay. We've seen some staples do okay. If you say that yields are going higher or going down, then you got yield-sensitive sectors in contrast. For example, utilities up, but real estate down. Regional banks up, but a lot of dividend-paying names down. So there wasn't really a particular theme on Friday, but if we contrast this with the weekly heat map, here it is. There is a theme now, and the theme is energy. When you have stagflation or risk in the economy, we see investors flocking back into energy. We've seen some other names shining this week. For example, you got Airbnb up about 10%, Blackstone up about 6% due to the inclusion in the S&P. That's not really a fundamental reason. We could see these names selling off next week. We also have the weight loss mania in Eli Lilly and NVO. Those names are moving higher this week. And while the classic AI names such as Nvidia went down big this week, about 7.5%, the reason is maybe China fears. Apple went down big. And now we have some contagion that anything tied to China should go down. So you see Tesla down, you see Apple down, you see Broadcom, Qualcomm, Skyworks all down big. We even see Nike down, Starbucks down. Anything related to China was down this week. Exception Intel. Intel was actually up about 8% for the week, so what's up with that? In the charts to watch video, we talked about how the chart of Intel is actually bullish. And Intel was hit with all kind of bad news. And it soaked up all of that bad news. Now it says, hit me. I don't really care. Whatever bad news you got, I'm numb now. I don't react to bad news. When stocks reach this kind of level, any good news pop these stocks higher. So we see Intel popping significantly higher. The opposite is happening in Nvidia. Nvidia soaked all of these good news. Now it becomes numb to good news. But it becomes extra sensitive to bad news. Any bad news, the stock goes down 7, 8, 9, 10%. But again, we say that not all of AI names were down. You look at Microsoft, that was up about 2% for the week. Oracle was up about 5% heading into earnings. Not a good setup here. You don't want to see stocks rallying into the print because the expectations become higher and higher and higher, and it becomes really difficult to beat. It becomes really hard to deliver. Now, when it comes to oil, a lot of you say, hey, what do we buy here, Maverick? And the answer is maybe you should wait for refiners to cool off. Maybe they're not going to cool off. Who knows? But I own Valero. I own MPC, Marathon. Both of them have been exploding higher in recent days. And if you want to know why, read the article in the Wall Street Journal that says it's a great time to be an oil refiner. So there is a reason why, a fundamental reason why we see these stocks exploding higher right now. From a technical standpoint, I think they're overbought, but they can be overbought for a long time. So when folks ask me about what is the best stock to own in energy, I don't have a singular name for you, but I have a sector within a sector, which is refiners. Refiners will do the best right now, and oil services names such as SLB will do pretty good. The big ones, Exxon, Chevron, BP, Phillips, they'll do pretty good, but it is contingent on higher crude prices. So long as crude goes higher, these names will do okay. But the refiners and the oil services name will do pretty good regardless. In my opinion, at least. Now, a lot of you have been asking me about CVS and Walgreens. What do we do here? Oversold, overbeaten? Is it time to buy? My response is, if you're looking for a trade, sure. But do you really want to own these companies? Because, sure, these stocks will bottom on bad news. Oh, we got a lot of bad news for Walgreens this week. From paying $44 million to settle the claims from Theranos, from losing the CEO. We know all of that. And maybe the stock is bottoming right now. But don't expect explosive growth here. You might stall, even go down more. And the reason is these companies are pretty much being disrupted right now. A, they have higher input costs, which online pharmacies and online providers of drugs don't really have. When you think about CVS and Walgreens, they're pretty much a convenience store that has a pharmacy in it, and that's the only differentiator. But you go to the pharmacies, you wait in line, it's a horrible experience. And now you got a lot of competitors, online competitors, such as Amazon, such as the company by Mark Cuban. You can just order your drugs online, receive them in the mail, and you don't have to go to CVS or Walgreens. So these companies are being disrupted right now. And I don't want to own companies that are being disrupted. You want to trade them, sure. But owning them, that's a different story. Now, another stock that we have to talk about is Etsy. And I'm short Etsy. I've been short since 21, but maybe I'm supposed to cover here. And the reason is, believe it or not, this Taylor Swift / Beyonce tours have been really good for Etsy. If you're going to go to Taylor Swift, you're not just going to buy the tickets and show up. Oh, you got to prepare for weeks to buy the dresses, to buy the bracelets, the glasses, all kind of shit. For Beyonce, you got to find a silver outfit and jewelry and all of that. So Etsy is also benefiting, just like hotels, from Taylor Swift and Beyonce. We look at the weekly heat map for the ETFs. What do we see here? Red across the board. In a week when the dollar and yields went higher, we see everything down. But the only actual resilient sector in the economy is energy. And the reason is inflation is not dead, not even close. Inflation is actually moving higher. And therefore, we see the XLE, XOP, OIH, the only outperformers this week. And we also see a sign of life in the XLU utilities. So is this a leading indicator that bond yields are about to go down, utilities will go higher, and then we see the CPI and bond yields go higher again? This is at least one scenario you got to keep in mind. But folks, let's do some charts here and wrap it up when we begin with the SPY. 30 minutes chart, what do we see here? We're seeing a lot of mixed messages here. Maybe as a result of the manipulation by the market maker due to options expiration. So we have a rising wedge pattern in the SPY, the Qs, many other charts. Did not play out. We actually broke out. But then the chart moved back pretty much to the neutral line. So of course the bears would look at this and say, look, the rising wedge is for real. And Friday's action was a throw off because of the market maker and options expiration. And now we're going to go back to playing out the wedge pattern. And down we go. The bulls will counter and say, not so fast. The action from Friday actually maybe forms an inverse head and shoulder pattern. Well, we know if the bulls are right if we see the SPY trading above 446.5 comes Monday. We know the bears are going to be right if we trade at or below 443 comes Monday. We look at the daily chart for the continuous contract for the S&P 500. What do we see here? Now we have a gap higher because the contract was updated. But all in all, the action in the SPY was flattish. So we're going to skip the futures contract, at least for today, because we can't rely on this chart right now. Even though the bulls would argue that, hey, we have a higher low, the bears would say, but you have a lower high, and we can go back and forth with no resolution here at all. So we do the SPX, the cash index. What do we see here? What we know for now is we're above 4,443.64. And we also have a pattern of higher lows and lower highs. If we start to trend higher from this point on, without revisiting the trend line, then most likely than not, we're going to have a break above the triangular consolidation pattern. If we lose 4,403.64, and we start to trend down back to the trend line, then it becomes more likely than not that the SPY, the SPX in this case, will break the wedge pattern, the triangular pattern, whatever you want to call it, doesn't matter to me, but it will be broken to the downside. If we remove all of these drawings and we use the Fibonacci / the 20 MA and the 50, 20 in white, 50 in blue. What do we see here? We closed below the 50, so we got a rejection from the 50 right now. No confirmation yet, but if we lose the 20 MA, if we have a closing below the 20 MA again, that would be a confirmation that the S&P is going down. And you should be in the short side, not the long. We look at the weekly chart for the SPX. What do we see here? On this one, we have a chart that is trading above the 20 weekly moving average, and that's bullish, not bearish. But do we see leading indicators that perhaps we have a bearish development coming out here? The answer is yes. We have negative divergence on the RSI. We have negative momentum in the MACD indicator. If it plays out, we could be seeing an inverse ABC pattern. We lose the 20, and the chart heads back to the 50-week moving average. Look at the Qs, the NASDAQ. What do we see here? Again, a rising wedge pattern that did not play out. We actually went higher. Closed the gap, then went down, closed flattish, and we lost the most important line, 372.74. Now, this is the top of the bearish engulfing candle, so close below is bearish, close above is bullish. But can we have a definitive conclusion looking at this chart? The answer is not really. The bears would look at the wedge pattern. They will look at Friday's action as a throw-off. They would look at the MACD indicator as suggesting perhaps more downside coming. They would look at 372.74, closing below as a bearish signal. So the bears have a lot of ammunition here. The bulls have what? We have a higher low. We did not break the lows yet, and we're really close to 372.74. Who's to say we're not going to take that back comes next week? And for that, we have to use the daily chart for the cues this time around. We use the Bollinger Bands, the 20 MA. What do we see here? We closed below the top of the bearish engulfing candle. That is bearish, not bullish. But did we lose the 20 moving average? The answer is not yet. So we have a reversal sign. We have no confirmation yet, but another piece of ammunition to the bears. If we plug in the 50 MA in blue, what do we see here? It appears that we lost that on Friday's session. So we have a rejection and a loss of the 50 MA, and then we have now perhaps a revisit to the 20 MA, maybe a loss of that. If that is the case, then we have more damage coming. If we look at the daily chart for the continuous contract for the NASDAQ, again, we have an update of the contract, so we see it gapping higher. So for now, that's a throw off. We're not going to make any assumptions based upon this chart. But we know that we have a bullish trend line for now, at least on the micro scale. And that's not going to be reversed until we see a loss of 15,000 of support. We look at the NDX, the NASDAQ 100, the daily chart. What do we see here? Closed below the 50 MA. That's not good, but we haven't lost the 20 yet. So that will be confirmation number 2 to become bearish, and confirmation number 3 would be losing the trend line, which could coincide with 15,000. My number here is 14,940, but you can round that up to 15,000. We look at the weekly chart for the NDX. What do we see here? For now, trading above the 20 MA, so this is bullish, not bearish, but you got negative momentum in the RSI, negative momentum in the MACD indicator, so this could be all leading to an inverse ABC pattern. And we lose the 20 MA, and we go down to the 50. And bear in mind that losing the 20 MA on the weekly chart is more significant than losing it on the daily. You can lose it on the daily and then get it back the next day. On the weekly, it usually signals a confirmation for a trend reversal. Perhaps a leading indicator for the technology sector on the NASDAQ is chips, the SMH. Daily chart, what do we see here? We lost the 50 and the 20 MA. So you got a confirmation here in chips that this is bearish and it's leading. The NASDAQ and technology is bearish too. Another favorite leading indicator is the IWM, the Russell 2000. What do we see here? In last week's video, we looked at this and we said, look, everything's bearish here. But the bulls can look at the closing above the 50 MA and the IWM as bullish. Well, we now know it was a trap. And the IWM went down, losing the 50 and the 20 MA. Not only that, it lost 185 by the end of the week. So if this is a leading indicator, along with chips, they are suggesting more downside to come. And we have 181.61 as the next support here. Then we have 176.24. We look at the KRE, it's an important component of the IWM. This is for regional banks. We can look at this as an inverse head and shoulder pattern that played out. But watch this. The inverse head and shoulder may be becoming an actual head and shoulder now. And we lost the trend line already. When we plug in the moving averages, what do we see here? We lost the 50, we lost the 20. This is bearish, not bullish. We look at the Dixie, the dollar index, an hourly chart. What do we see here? Now the Dixie has been consolidating within range. Support 104, 667 basis points, and the resistance at 105.103 basis points. And what we got on Friday is it dropped down when wholesales came out. We went down all the way to 104.667, and the algos bought the stock market. We saw the stock market moving higher, and then we caught a massive rebound. And by the way, one of our members on Discord caught all of this in the chat room. They said, watch out, we got a rebound coming, and the stock market is about to do 180. And indeed, this is what happened. So for now, when you look at a chart that caught support and closed at the highs, is this behavior bullish or bearish? The answer is it is bullish. But the problem for the dollar is, if we zoom out that daily chart, what do we see here? Using the Bollinger Bands, every time we got this high and maybe outside of the upper Bollinger Bands, we got a pullback, maybe a revisit to the 20 moving average. And if we do that, then the stock market is going to rebound. Simple as that. It's algorithmic, folks. Dollar goes down, the algos will buy equities. So the question now becomes, you look at this chart, maybe you're seeing a pullback in the dollar, which means a rebound in equities. Maybe this is what the seasonality is all about, but who's to say that the dollar is done here? Maybe the dollar wants to go a little crazy, and then it pulls back. This is what we have to watch for. What do we see when we visit the old man gold? What do we see here? Daily chart may be the formation of a head and shoulder pattern. We got a decent rejection from 1928, and now we have a head and shoulder pattern, suggesting that maybe the dollar has another pop coming. So we have mixed messages here. But we know in the case of the dollar going down, gold is going to pop higher, even if it is just a pullback in the dollar, and equities will also rebound higher. But maybe the old man here is saying, watch out, the dollar wants to pop higher. I'm not going to be cute here and move higher. I'm going to top right here and move down perhaps to 1900 and then maybe catch a rebound and move higher again. When we look at the weekly chart for gold, what do we see here? We had an uptrend, a really steep uptrend with higher lows. Now we have what it appears to be a downtrend with lower highs. The question becomes, if we stop here and start to move down, then we're going to form lower lows in the pattern. So it is really imperative for gold to start moving higher and break this lower high pattern. But maybe silver is suggesting that, yeah, they're going down. Gold and silver are going down. You look at the weekly chart for the SLV, we have a positive trend line for now. We need to see how it's going to hold if SLV goes down in a retest and then make an assessment. Maybe silver goes down to the trend line and the dollar catches a pullback and we see silver rebounding from this trend line. And that could be an opportunity for at least a trade. We'll see, but for now, you plug in the Bollinger Bands, we lost the 20 and 50 MAs in silver, and that is bullish for the dollar, bearish for precious metals, and bearish for the stock market. What about UK oil, Brent oil? What do we see here? It is absolutely bullish. The RSI is strong, so is the MACD, and we're now consolidating in a bull flag pattern at around 90.28. You can round that up to 90.5. It doesn't matter. Oil is strong, but it is consolidating right now, asking for buyers. If the buyers don't show up, then the sellers are going to book profits. And we see that the RSI is already elevated. We see the MACD almost overbought. We see the chart trading pretty much at the upper Bollinger Band. And the point being here is, if you made a lot of profits trading energy or being bullish energy, now is the time to book some profits or at least hedge, sell some covered calls, do something here. Because if the buyers don't show up, the sellers are gonna. Somebody's gonna sell for you. Don't be Johnny come lately. Have a plan. You're looking at the chart, you know what's gonna happen. If we have another pop, sure, we'll take that. Maybe we'll have some covered calls. And we get to exit some positions here at profit. But what if the pop doesn't happen? What if the buyers don't show up? What if we have a pullback? The 87.28, maybe to the 20 moving average here. You're going to lose a lot of the gains that you got this week, so why not have a plan? We look at the weekly chart for UK oil. What do we see here? We know that usually when the weekly chart of crude oil trades above the Bollinger Bands, we're going to get a pullback. But there was one instance when oil was expanding the Bollinger Bands, priming for a massive, explosive move higher. Now the question becomes, what do you believe? Is it going to be the big explosive move higher, or are we going to follow the probabilities here and say that we have a pullback imminent for oil? We look at the 2-year yield. What do we see here? Honestly, nothing to see here. Within range, the support 4.874 basis points, the resistance at 5.085%, so nothing happened here. We got the bear flag. We lost support for a moment, but yields recovered right away. You look at the behavioral element of the chart, that's bullish, suggesting that the 2-year could move higher, maybe break to make new highs. But the chart right now, the pattern overall, says that with neutral, we can go either way. We look at the 10-year yield, an hourly chart. What do we see here? The warning on Friday in Discord was, what if we have a topping head and shoulder? Well, we now know that we don't have a topping head and shoulder because the closing was above the top of the shoulder. Is that bullish or bearish for the chart? The answer is it is bullish, but it is without confirmation. If we zoom out to the daily chart, you can still see a topping head and shoulder potential. Keyword potential. But you could also look at it as perhaps a bull flag pattern. You can look at the recent positive divergence in the RSI as a leading indicator that the 10-year will make higher highs. And a reminder, in our 1987 conversation, a sharp reaction in equities to the downside happens when the 10-year makes and confirms new highs. We're getting really, really close here. There was a big move coming, folks. I don't know what direction it is. You know what my bias is. I think yields are going to pop higher, and I think equities are going to flush down big. But the point being here is, watch the bond market. We have a massive move coming here. We look at the 30-year yield daily chart. What do we see here? You can argue that we have maybe a topping head and shoulder pattern. 30 goes down, and equities are going to recover, and everybody's going to live happily ever after. Well, what if this is a bull flag pattern? And we see the 30 breaking out, the 10 breaking out, the 2 breaking out. Equities will go down, folks. We'll look at the VIX, an hourly chart. What do we see here? We have a break in pattern. We're looking for higher lows, higher highs. Now we have a lower low, a lower high. This is bearish, not bullish, at least for the VIX. If we look at the daily chart, we're now below the gap support. So again, this is bearish for the VIX, which means it's bullish for the equities market. So if you happen to be bullish, you'd look at this and say, look, the VIX is going to go down. That means equities are going higher. Maybe the seasonality for September will play out. The bears will counter and say, forget about the VIX. The VIX is broken, and you gotta look at the charts. Forget about the VIX, and the chart says we're going down. It's a debate for now. The VIX, as it looks right now, supports equities bulls, not equities bears. We'll look at Apple, an hourly chart. What do we see here? Again, we have a wedge pattern that actually played out in this one. A rising wedge pattern that played out. Leading indicator for the stock market, who knows? But we need to see a lot of confirmations here before we say that we have more downside coming for Apple. And the confirmation, number one at least, would be losing 177.35. And then we have to see 175.38 also lost the support. But most importantly, we look at the daily chart. What do we see here? The chart got rejected from the 20 MA. It closed below all of these moving averages. That is bearish, not bullish. You look at the weekly chart. Are we about to see an inverse ABC pattern that will take us all the way back to the 50 weekly moving average? We lost the 20 already, and Apple is a leading indicator. As Apple goes, so will the market. Is Apple saying that the Qs will have an inverse ABC? The SPY will have an inverse ABC. And if that is the case, this is your opportunity right now to place those bets, but you gotta believe that Apple is indeed the leading indicator. Tesla, the souffle, an hourly chart. What do we see here? You know, the culties keep buying these call options every single morning because, oh, the robo-taxis because of fill-in-the-blank reasons. But they keep getting smacked in the mouth, and Friday was no exception, except, of course, they lost the trend line now, and they lost 249.16 as support, forming a bear flag pattern. So for now, the hourly chart is slightly bearish. We look at the daily chart, we have a rejection from the 50 MA, but no confirmation yet because the 20 MA remains intact. You lose the 20, you're shorting Tesla with both hands. You break the 50, you're going long Tesla with both hands, with the goal of what? Filling the gap above. Lastly, we move on to Bitcoin. What do we see here? The answer is on the daily chart, nothing at all. Consolidating, dead, no volume. We move on. We move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, September 11th, nothing at all. Tuesday, September 12th, nothing at all. Good days for the market to rebound and play out the seasonality, right? Then September 13th, we have the big day, the CPI, aka the CPLI. Then Thursday, the 14th, we have initial jobless claims, and perhaps more important than the CPI now, the PPI, along with retail sales and business inventories. Friday, September 15th, we have import prices, the Empire State Manufacturing Survey, along with industrial production and capacity utilization. That comes on top of the preliminary reading of consumer sentiment from the University of Michigan. And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
When General Motors has to go to the bathroom 10 times a day, the whole country's ready to let go.
Oh, Stella, in economics, a kidney ailment has no relationship with the stock market, none whatsoever.
It crashed, didn't it?
You're out of touch.